To understand this move properly, we must step away from emotion and look at the mechanics. First factor, the US dollar strengthened. When the dollar rises, commodities priced in dollars become more expensive globally. That reduces demand pressure in the short term. Silver, being highly sensitive to currency fluctuations, often reacts sharply to dollar momentum. As the dollar index gained strength, metals came under pressure. Second factor, bond yields climbed. Real yields matter deeply for precious metals. Silver does not pay interest. When treasury yields rise, holding metals becomes less attractive compared to yield-bearing assets. Institutional capital reallocates. That shift alone can create significant selling pressure. Third factor, profit-taking. Silver had previously rallied strongly. Many leveraged traders were sitting on gains. Once momentum slowed and key technical levels cracked, stops were triggered. Algorithmic trading systems amplified the move. This is important. Modern markets are highly automated. Once certain support levels break, computers execute orders rapidly, accelerating downside pressure. Fourth factor, industrial demand concerns. Silver is not just a precious metal, it is heavily tied to industry. Solar panels, electronics, EV infrastructure. When economic data from major manufacturing economies weakens, silver feels it faster than gold. Investors begin pricing in slower industrial growth, and silver often falls harder because of that dual identity. But here's where it becomes interesting. A nearly 17% monthly correction is historically significant. When we look at past cycles, drops of this magnitude typically occur at inflection points, not random mid-trend pauses. In previous years, sharp corrections of 15 to 20% often preceded one of two outcomes. Either the metal entered a multi-month consolidation phase where volatility compressed before the next breakout, or the drop marked capitulation, the final aggressive sell-off before a powerful reversal. So the key question becomes, was this a normal correction in a broader uptrend or the beginning of a deeper structural breakdown? The answer lies in context. The $74 level is not random. It previously acted as a resistance zone during earlier consolidation phases. Markets remember these levels. What was once resistance often becomes support when retested from above. This is a classic technical principle known as role reversal. When silver dropped rapidly and tagged $74, volume increased significantly. That spike in volume is crucial. High volume at lows can signal capitulation, a point where sellers exhaust themselves. But volume alone is not confirmation. Momentum indicators such as RSI likely approached oversold territory during the decline. Historically, when silver's RSI reaches extreme oversold readings on higher timeframes, bounces often follow. Not guaranteed rallies, but relief moves. Now consider moving averages. If the 200-day moving average sits near this zone, it strengthens the support case. Long-term trend followers watch that level closely. Institutions often defend those areas unless macro conditions deteriorate dramatically. But technical analysis is about scenarios, not predictions. Scenario 1, bullish stabilization. If silver holds above $74 and begins forming higher lows on the daily chart, reclaiming $80 becomes the first confirmation signal. That psychological $80 level matters. A decisive close above it could attract momentum buyers back into the market. Short sellers may cover positions. That combination can create a squeeze higher toward $85, $90. In this scenario, the 16.91% drop becomes a shakeout, painful but temporary. Scenario 2, breakdown continuation. If silver breaks below $74 with strong volume and fails to reclaim it quickly, that level transforms from support back into resistance. In that case, downside targets may open toward $68 or even $65, where previous structural demand existed. This is why patience is critical. Many traders lose money not because they are wrong about direction, but because they enter too early without confirmation. Markets rarely reward impulsive decisions. Let's also address the concept of volatility compression. After large monthly declines, markets often enter sideways phases. That sideways movement frustrates both bulls and bears. It creates boredom. But those consolidation periods build energy for the next expansion move. So if silver begins trading between $74 and $82 for several weeks, that would not be weakness. That would be structural rebuilding. Another critical element is positioning data. When investors believe rates will stay higher for longer, real yields rise, and that creates a headwind for silver because it does not generate income. Capital naturally flows toward assets that offer yield, safety, and liquidity, and in those moments, precious metals often lose short-term appeal even if their long-term fundamentals remain intact. This is one of the most misunderstood aspects of silver investing. Silver can be bullish long-term while still suffering painful short-term drawdowns when policy expectations shift. At the same time, the US dollar has shown renewed strength. This matters deeply. Silver is priced globally in dollars, so when the dollar strengthens, silver becomes more expensive for non-US buyers. That dampens demand at the margins. Even small changes in the dollar index can create outsized reactions in silver because silver is thinner and more volatile than gold. Over the past month, dollar strength combined with rising yields created a double pressure, one pushing from currency markets, the other from bond markets. When those two forces align, silver almost always struggles in the short term. This is not a theory. It is observable across decades of market history. But macro pressure doesn't stop there. Industrial demand plays a crucial role in silver's price behavior, and this is where silver diverges sharply from gold. Silver is both a monetary metal and an industrial input. Roughly half of annual silver demand comes from industrial uses: solar panels, electronics, medical equipment, electric vehicles, and infrastructure. That means silver is sensitive to global growth expectations. When economic data from major manufacturing hubs weakens, silver feels it immediately. Over the past month, signals of slowing manufacturing momentum, particularly in Asia, have raised concerns about near-term industrial demand. Even if long-term demand from green energy remains strong, markets price the next 6 to 12 months first. Short-term fear can overpower long-term optimism. This creates a paradox that confuses many retail investors. On one hand, the world is moving toward electrification, renewable energy, and increased technological complexity, all of which require more silver. On the other hand, markets are forward-looking and highly reactive. If investors believe growth may slow temporarily, they reduce exposure now, even if demand rebounds later. That is why silver can drop sharply even while its long-term demand story remains intact. Understanding this disconnect is critical because it explains why emotionally driven decisions often fail in commodity markets. Another major macro driver is inflation perception. Silver has historically been viewed as an inflation hedge, but that relationship is not linear. Silver tends to perform best when inflation is high and rising, or when inflation is falling and rate cuts are expected. It struggles in the middle zone when inflation remains sticky and central banks stay cautious. That is exactly where we are now. Inflation is not spiraling out of control, but it is not disappearing either. This sticky inflation environment keeps policymakers cautious and markets uncertain. Uncertainty breeds volatility, and volatility without clear direction often leads to sharp corrections like the one we just witnessed. Let's also talk about liquidity, because liquidity quietly controls everything. When financial conditions tighten, whether through higher rates, reduced lending, or cautious institutional positioning, speculative assets suffer first. Silver, despite its history, trades like a high beta asset during tightening phases. That means it exaggerates moves. When liquidity flows out, silver doesn't decline gently. It drops hard. This is why a 16.91% monthly decline, while shocking emotionally, is not abnormal structurally during macro tightening phases. It feels extreme because of speed, not because of historical rarity. Now consider global risk sentiment. When investors feel confident, they are willing to hold volatile assets. When fear rises, they de-risk. Over the past month, global markets have been oscillating between optimism and caution. Equity volatility, geopolitical uncertainty, and uneven economic data have kept investors defensive. In such environments, gold often holds up better than silver because gold is seen primarily as a store of value, while silver is seen as a hybrid asset. That hybrid nature makes silver more vulnerable when risk appetite contracts. However, here is where perspective becomes crucial. Macro pressure does not last forever. Monetary cycles turn, dollar strength fades, growth expectations reset. What matters is not whether silver is under macro pressure today, but whether that pressure is accelerating or peaking. Markets move ahead of reality. By the time macro data clearly improves, prices have often already moved. That is why major reversals rarely occur when headlines turn positive. They occur when selling pressure exhausts itself while news is still negative. We must also acknowledge supply dynamics. Silver supply growth has not exploded. Mining output remains constrained in many regions due to rising costs, regulatory pressure, and declining ore grades. This does not cause immediate price spikes, but it limits how much supply can respond to demand over time. When demand recovers, supply cannot instantly catch up. This structural constraint underpins silver's long-term bullish case, even if short-term price action looks ugly. So where does that leave us right now? It leaves us in a classic macro transition zone. Rates are high, but expectations are shifting. Inflation is sticky, but not accelerating. Industrial demand is slowing short-term, but structurally rising long-term. Liquidity is tight, but not collapsing. These are the environments where silver becomes extremely volatile and emotionally difficult to hold. They are also the environments where long-term opportunities quietly form, not through blind buying, but through disciplined observation. The mistake most investors make is assuming macro conditions must improve before price can rise. In reality, price often moves first. Macro confirmation comes later. If silver stabilizes near $74 despite continued macro headwinds, that resilience itself becomes information. It tells us selling pressure may be exhausting. On the other hand, if macro conditions worsen and silver breaks decisively below structural support, then patience is required, not stubbornness. This chapter is not about telling you silver must reverse or must fall further. It is about understanding the forces acting on it so you are not emotionally hijacked by price alone. Silver is being pulled in opposite directions, long-term structural demand versus short-term macro pressure. When those forces collide, volatility explodes. That is exactly what we are witnessing now. The smart approach in moments like this is not prediction, but preparation. Understand the macro backdrop. Watch how price reacts to it. Because when macro pressure peaks and price stops falling, that is when markets quietly change direction. Not with headlines, not with celebration, but with silence. If speculative long positions have decreased significantly during this drop, that reduces downside pressure. If large commercial hedgers begin reducing short exposure near $74, that could signal confidence and stabilization. Again, no single data point gives certainty. But when multiple factors align, technical support, oversold momentum, declining speculative longs, stabilizing dollar, probabilities shift. The market right now is in assessment mode. This is where experienced investors remain calm. They do not chase red candles. They do not panic, sell into support. They wait for structure, and structure is forming at $74. The next several sessions will likely determine whether this level becomes a launch pad or a trapdoor. Now we arrive at the most important chapter. Not charts, not interest rates, not industrial demand, but psychology. Because at the end of the day, markets are driven by human behavior. Fear, greed, impatience, overconfidence, regret. These emotions move price just as much as macroeconomic data, and silver, more than most assets, amplifies emotion. It moves fast, it punishes hesitation, and it rewards discipline. That 16.91% monthly drop did not just reduce price, it attacked confidence. It forced investors to question their thesis. It created doubt where conviction once lived. Think about what happens mentally when price falls this quickly. When silver was above $90, investors felt validated. They believed the trend would continue. Every dip was seen as a buying opportunity. But when the drop accelerates, that mindset flips. The same investors who were confident at $92 begin to feel nervous at $85, anxious at $80, and fearful at $74. Nothing fundamental changed overnight, only price did. And price movement alone is powerful enough to alter perception. This is why markets often bottom in fear, not optimism. At major turning points, the majority rarely feels comfortable. In fact, the most powerful reversals begin when conviction is weakest. That doesn't mean every drop leads to a rally, but it does mean that emotional exhaustion often precedes structural change. Let's talk about the retail investor first. Retail participants tend to chase momentum. When price rises strongly, they enter late. When price falls sharply, they exit near support. It is not because they lack intelligence, and it is because they lack process. Without a predefined strategy, emotions take control. A 16.91% drop feels catastrophic, even if historically it fits within normal volatility ranges for silver. Now consider professional traders. They approach markets differently. They do not ask, is silver good or bad? They ask, where is risk defined? At $74, risk becomes measurable. If support holds, upside potential outweighs downside risk. If it breaks, they exit quickly. Professionals focus on probability and position sizing, not predictions. This is the mindset shift viewers must understand. Silver at 70 cents out of 40 is not an emotional event. It is a structural event. The difference between those two interpretations determines outcomes. Now let's break strategy into clear categories so every viewer understands where they stand. For long-term investors, those who believe in silver's multi-year structural demand story driven by electrification, renewable energy, monetary instability, and supply constraints, short-term corrections are part of the journey. But even long-term investors should avoid blind accumulation. Smart long-term strategy means scaling in near structural support, not chasing rallies. It means holding conviction only if the macro thesis remains intact. If your reason for owning silver was inflation protection and industrial growth, ask yourself, has that thesis truly collapsed, or has price simply corrected? For swing traders, patience is everything. A bounce from $74 without confirmation is speculation. A reclaim of $80 with volume and higher lows forming is structure. The difference between guessing and waiting for confirmation often determines profitability. Traders must detach from opinion and follow price behavior. For physical silver buyers, often called stackers, volatility is opportunity, but discipline still matters. Emotional buying during rallies and hesitation during dips is common, but historically physical demand increases during corrections because value perception improves. The key is consistency. Gradual accumulation during weakness rather than aggressive buying during hype has historically produced stronger average cost bases. For leveraged traders, caution is critical. Silver's volatility can amplify gains, but it can also erase accounts. Risk management is non-negotiable. Stop placement, position sizing, and capital preservation matter more than directional conviction. Now let's address the deeper psychological layer, uncertainty. Right now, the market is not certain about rates, inflation, growth, or currency direction, and when uncertainty dominates, volatility expands. Many investors interpret volatility as danger. Professionals interpret it as movement. Movement creates opportunity, but only for those prepared. Another psychological trap is narrative bias. When silver rises, bullish narratives dominate headlines. When silver falls, bearish narratives multiply. The human brain seeks stories to justify price, even though price often moves before stories are formed. Understanding this protects you from being swayed by emotional headlines. Here's a powerful question every viewer should ask themselves. If silver rallies back above 85 next month, will today's fear look justified? And if it breaks below $70, will today's optimism look naive? The truth is, nobody knows with certainty. But what you can control is preparation. Preparation means defining your levels. For example, if $74 holds in higher lows form, you prepare for upside continuation. If $74 breaks with strength and fails to reclaim, you prepare for deeper retracement. That is not prediction, that is conditional planning. Now let's zoom out one final time. Markets operate in cycles. Expansion, excess, correction, reset, expansion again. The 16.91% monthly drop may represent a correction within a broader cycle, or it may represent the early stage of a deeper reset. The only way to know is through behavior at key levels, and $74 is currently that level. What makes moments like this powerful is not certainty, but asymmetry. When price reaches major support after aggressive selling, downside risk becomes clearer while upside potential expands if stabilization occurs. That asymmetry is what experienced investors look for. But here's the most important truth. No single trade defines your future. No single month defines silver's destiny. Markets are long games. Emotional reactions create short-term mistakes. Strategic patience creates long-term results. So as silver sits near $77.40, after a brutal monthly correction, the question is not, is silver dead? The question is structure forming? Watch how price behaves around $74. Watch volume. Watch reaction to macro headlines. Watch whether sellers continue dominating or begin losing momentum. Because when selling pressure exhausts itself, markets often turn quietly. Not with celebration, not with warning, but with subtle strength. And that brings us to the final perspective. Volatility is uncomfortable. It tests conviction. It exposes weak positioning. But volatility is also where opportunity lives. Calm markets rarely create wealth. Transitional markets do. Right now, silver is transitioning. Whether that transition leads to recovery or deeper correction depends on forces still unfolding. But one thing is certain, this is not a random price level. It is a decision zone, so do not react emotionally. Do not follow panic. Do not follow hype. Follow structure. If $74 holds and strength builds, this month may be remembered as the shakeout before continuation. If it fails, discipline will protect you from unnecessary loss. Either way, the prepared investor wins, silver will move. It always does. The only real question is, will you be reacting or ready? If speculative long positions have decreased significantly during this drop, that reduces downside pressure. If large commercial hedgers begin reducing short exposure near $74, that could signal confidence and stabilization. Again, no single data point gives certainty. But when multiple factors align, technical support, oversold momentum, declining speculative longs, stabilizing dollar, probabilities shift. The market right now is in assessment mode. This is where experienced investors remain calm. They do not chase red candles, they do not panic sell into support. They wait for structure, and structure is forming at $74. The next several sessions will likely determine whether this level becomes a launch pad or a trap door.